the concept of mutual fund. Mutual fund is not going to invest in a single asset. In spite of that, mutual fund is going to invest in multiple assets. If you take an investor, may not be able to invest its available portion of investment or available portion of money is going to be invested into the different investment avenue is not normally possible, but it can be possible if they are going to make investment into the mutual fund. In every rupee of investor is going to be invested into the different investment avenue, or every paise of investor is going to be invested into the different investment avenue. So in the class example itself, I have explained you one particular scheme. So say for example of the scheme, ICICI Prudential Asset Management Company has floated a scheme called BFSI Fund. It means Banking Financial Services Insurance Fund. So that will be floated by ICICI Prudential Asset Management Company. In this BFSI scheme, they are going to make investment into the 32 companies. So you understand the scheme, ICICI Prudential Asset Management Company. Name of the scheme is Banking Financial Services and Insurance, BFSI scheme. So in this scheme, what the asset management company is doing, they are going to collect the investment from the investor, and those investment is going to be invested into the 32 companies. The equity shares of 32 companies are going to be invested under this scheme. Please understand. So they have floated the scheme with the face value of rupees 10 each. The unit value is rupees 10. It means what? If the investor is going to buy a unit from this BFSI scheme, they have investor is invested into the 10 rupee into the scheme. The 10 rupee is going to be invested into the 32 companies, which means every 31 paise of his investment is going to be invested. Every 31 or 35 paise of his investment is going to be invested into a company. So they are going to make investment of 32 companies out of his 10 rupee. Really, if you have a 10 rupee, whether you can be able to understand whether you can be able to buy a single share, it is not at all possible, absolutely not at all possible. So it can be only possible while you are going to make investment into the mutual fund. So at this point of time, I'll just recall the meaning of mutual fund. Mutual fund is a vehicle for collecting investment from the investors and pull it into the various investment avenues. So in this example, you need to understand the meaning of mutual fund. The meaning of mutual fund here, it is mentioned, is a vehicle, is a purpose, is an objective of asset management company is going to make investment, collecting investment from the investors. And what happens to the investment? That investments are pooled together, combined together, and that should be invested into the various investment avenues. What are those investment avenues? Investment avenues in the form of equity shares, in the form of preferential shares, in the form of bonds, or combination of investment avenues, or real assets it is going to make investment. So in the different ways, in different avenues, in different market, that they are going to make investment. So this particular avenue, this particular concept of scheme, we call it as mutual fund. Investment in mutual fund. Next topic is investment in mutual fund. So you are going to make investment. How the investment is going to be invested? What would be the process of investment in mutual fund? So the process of investment in mutual fund, let the concept has started with the investors. So in that, the investors, the concept that starts with the pooling of their money with fund manager who is representing on behalf of asset management company. So the investor is going to make investment. That investment is received by a person, designated person, who is called it as fund manager. So what is the role of fund manager? Whatever the money have been collected from the investor is going to be invested into the securities. What are those securities? It is going to make investment into the equity shares, preference shares. It is going to be invested into the debentures, public sector bonds, private sector bonds. It is going to be make investment into the different securities. So with that, the securities are going to generate the returns. So the returns might be in the form of current returns and capital appreciation. So the returns are to be collected, pass back the returns to the investors, either in the form of current returns or in the form of capital appreciation. Either it is going to be retained by the scheme itself, or the scheme is going to be paid out to the investor. So this is what the simple process, the operational process of mutual funds, the operational process of asset management company to understand the concept of mutual. So next one is about the history of mutual funds. In different phases, I am going to explain you the concept of mutual funds. So the phase 1, you take 1964 to 1987. In 1963, Unit Trust of India was setting up by the Parliament under UTI Act, given the monopoly. At that particular point of time, UTI is the only asset management company who issue the mutual funds in Indian market. This was considered as they have launched a first equity scheme in the year 1986. They consider as a monopoly in the market. The phase 2, 1987 to 1993, non-UTI. Apart from that, the government is also opened up the market for public sector mutual funds. So the public sector mutual funds, normally they give the priority to the banks, financial institutions, insurance companies, that they are setting up of their own mutual funds. With that, the SBI mutual funds, SBI Asset Management Company, Can Bank Asset Management Company, LIC mutual funds, Indian Bank Mutual Fund, GIC Mutual Fund, PNB Mutual Funds are those mutual funds which were set up by the public sector undertakings. The third phase, 1993 to 2003, the entry of private sector into the market, which was we can take the Gotari Pioneer. Now it was renamed as, it was merged in Franklin Templeton, was the first private sector mutual fund, have been registered in the year 1993. At the end of 2003, there were 33 mutual funds with a total asset of 1,21,805 crores of corpus have been collected from the investors about the market value. The fourth phase, since 2003, following repeal of the Unit Trust of India Act 1963, UTI was separated into the two major entities. One is Specified Undertaking of Unit Trust of India. Its asset under management is about 29,835 crores at the end of 2003. Then the second segmentation of UTI has divided into the UTI Mutual Fund Limited, which has been sponsored by SBI, PNB, POB, State Bank of India, Punjab National Bank, and Bank of Baroda and LIC. Are those entities which comes under the regulation of SEBI. So the next case is the types of mutual funds. Based on the different parameters, the mutual funds are to be divided into the various categories. The first one, in terms of its structure, we classify the mutual funds into open-ended schemes, closed-ended schemes, and interval schemes. So what is open-ended schemes? With that, the open-ended schemes, the schemes remains open whenever or wherever you would like to join, wherever you would like to withdraw your fund from the market can be allowed. So this particular scheme we call it as open-ended scheme. So under the open-ended scheme, the investor can join at any time. Investor can withdraw his money, either going for partial withdrawal or full withdrawal. That can be possible under the scheme. We call it as open-ended scheme. And closed-ended scheme, that the closed-ended scheme, the investor is allowed to join with a particular period of time. what we call it as, it is like NFO, new fund offer given by the scheme. At the time only they can be able to join with the scheme, and they can be able to redeem, they can be able to withdraw their money only at the particular period of time. There should be a long-in period is applicable for the closed-ended scheme. So let you understand this two concepts, open-ended and closed-ended scheme. What is open-ended scheme? The investor can join at any time, investor can withdraw his money at any point of time. Hence, what would be the value is applicable for the open-ended scheme? Intrinsic value, the real value which will be applicable for the open-ended scheme. Whereas the closed-ended scheme, you can't be able to redeem within a particular period of time, but there is a separate market is available for the closed-ended scheme. You can buy in primary market, you can sell it in a secondary market, you can be able to sell the scheme in secondary market through the stock exchanges, you also can able to sell. So there should be a market value is applicable for the closed-ended scheme. Then what is the interval scheme? Some more time, if the closed-ended scheme, so hope you all aware, while we are going to start the scheme, there should be a corpus, there should be investment is required for starting up of the scheme. So the scheme itself, they have fixed the value or a target of amount to be collected from the investor, then only the scheme is going to be started. For example, you take the closed-ended scheme has been started, the closed-ended scheme having an investment target of 300 crores, but actually 200 crores only subscribed at the end of the period. So NFO is having a opening date and closing date, it is similar to the application. So they need to find fill the application or the proposal that should be submitted to the asset management company on or before the deadline, on or before the last date. So after the last date and specified period of time, the NFO is opened in the market. So they will be allotted the units, and the units are traded in the market. So what happened, instead of 300 crores, they have only 200 crores issued in the market, so that the unit holders are available in the market. So what asset management companies are doing, remaining 100 crores they need to collect. So that 100 crore can be floated as a separate instrument, which we call it as interval scheme. So it is a kind of closed-ended scheme. Balance amount will be collected from the investor, under the scheme we call it as interval scheme. So these are the type of mutual fund scheme on the basis of its structure. Second one, by investment objectives, based on the investment category, we are going to classify the mutual fund scheme. For example of growth funds, income fund, balanced fund, money market funds, load fund, no load funds. So the first one, growth funds or growth schemes, what we call it as a growth scheme, majority of the portion of money is going to be invested into the equities, and remaining portion is going to be invested into the fixed income bearing securities. For example of the growth scheme, whatever the money is collected from the investor, almost up to 60% of the fund is being invested into the equity, and remaining 40% is invested into the debt. Income funds, the major benefit of the income funds is the majority or the major portion of the fund is going to be invested into the fixed income bearing securities. It means up to 80% of the fund is invested into the debentures. So the income what we are receiving in debenture is going to be given back to the investors under the income funds. Balanced fund is a combination, is a hybrid fund, is a combination of debt and equity. For example, up to maximum of 40% of equity, 40% of debenture, and 20% of fund is going to be invested into the money market. We call it as a balanced fund. And what is money market funds? Almost the major portion of funds is being invested, almost 80% of the fund is being invested into the money market. Load fund and low load fund, which means entry charges and exit charges may applicable for this kind of scheme. We call it as load fund. Entry and exit loads and other charges will not be applicable for the kind of schemes. We call it as no load schemes. Other schemes, like you take example of tax saving scheme, is going to be like for example of ELSS scheme, equity linked saving scheme. So the equity linked saving scheme, with this the objective of this scheme is providing the tax benefit to the investors. So the investors is going to make investment under the scheme for getting ATC exemption. And the SIP, systematic investment plan, they are going to make investments, and periodically they are going to make investments. The kind of schemes, SIPs, and what we have sectoral schemes, and we have the thematic schemes, specific groups going to make investment. There are different schemes in modern scenario in mutual funds that we have. The next one, we have the advantages of mutual funds. So what are the advantages that the investors are going to make investments into the mutual funds? You need to understand the reason. The first one, portfolio diversification, professional management, reduction of risk, reduction of transaction cost, wide choice of risk and return profile, liquidity, convenience and flexibility, transparency. So let me take the first one, portfolio diversification. The portfolio diversification, mutual fund is what? Is exactly a portfolio. What is a portfolio? Portfolio is a combination of securities, a combination of assets. Mutual funds are also going to make investment into the different investment avenues. What we call it as is a portfolio diversification. The professional management is a team you need not to manage. If you are not able to understand the market, you are not having capability of investing into the market, you need not to make investment. In spite of your professional competence, a team of professional competence on behalf of you, they are going to make investment, they are going to manage your funds. So it's an advantage of making investment into the mutual funds. Reduction of risk, it is not going to be invested into the single asset, it is going to be invested into the number of assets. So the risk is going to be a diversified one, which is going to reduce your risk, reduce the probability of failure. And the reduction of transaction cost, it is not going to make purchasing and selling of asset not for the individual investor, it is for the institutional investment, relatively cheaper cost compared to the individual transaction cost. Wider choice of asset which can be shoot the risk return profile, risk return appetite of the investors. Basically what the investor is going to select the scheme based on their risk and return profile. Accordingly they are going to make. See, say for example, if you are a young investor, you are going to make investment, is you are as an aggressive investor in the market, you are going to make investment into the equity oriented scheme. If you are in a middle age, between around you take 40 to 50, you take, without the period of time the people make investment into the scheme which should have optimum risk and return. So the kind of thing the people may go and investment into the balanced schemes, or like a growth schemes, they are going to make investment 50-50 chance. Like a old age people, they are making investment, it's like a conservative investors, they are going to make investment, they are investing into the kind of income schemes, they are going to investing in a kind of money market funds. Likewise they are going to invest in the market. So based on the risk profile, the investments are available in the market. Liquidity, whenever you just want to convert your securities into cash, that can be possible under the market. Either it is in open ended scheme, you will get the intrinsic value, or a closed ended scheme, the market value is applicable according to the market. It is a convenient way of investment. Even you can make the monthly transfer of money for purchasing of units, that can be possible, convenient, flexible in terms of its time period, in terms of closing the value. You need not to close or withdraw the entire value, you can be allowed to go for partial withdrawal. There are different benefits are to be provided under the scheme. Transparency, easy to evaluate, easy to understand, easy to review the price movement of the securities in the market, it can be easy. These are the advantages of mutual funds. While we need to understand the major disadvantages of mutual funds, no control over the cost is a tailor-made portfolios are not available. Managing a portfolio of funds, delay in redemption are the major disadvantages. Let me take the first one, no control over the cost. Whatever the cost is occurred is going to be paid by the investors who are all made investment into the asset management company. So there is no control over the cost. We are not going to limitating the cost. We are not going to make a reduction of cost. The cost may occur, that the cost we are going to sharing and we are going to pay the cost. And no tailor-made portfolio, whatever the requirement, if I am going to make some changes, is not at all possible. The mutual fund company can have a rights to make investment, so the investor may not be participated directly into this. It is not an active management strategy, it's a passive strategy, passive investment strategy. Managing a portfolio of funds, it is not individual asset is going to be invested. The managing a combination of asset, that becomes a difficult one to determine the price, determine the value of an asset, determine the unit price in the market. There might be the problem. Delay in redemption, if you have given a redemption request, withdrawal request, that should be processed, that the amount will be reached in delay. So it is what normally in consideration, but what nowadays a kind of online transaction, there is no delay. Session I am going to handle a topic on mutual funds. It's a continuation to the previous session. So in this I am going to explain you the net asset value, the components of net asset value, calculations of net asset value, the performance evaluation techniques, and the regulations of mutual funds. So the first one, net asset value. So you need to understand the concept of net asset value. The net asset value is the market value of mutual funds, is in terms of unit. So how we can say the micro portion of capital, we call it as a share. Likewise, a micro portion of a fund, the micro portion of asset investment by the mutual fund company, we call it as unit. The overall asset of a mutual fund depends on their market value per fund unit. If you add up the market value of the shares in the fund and divide by the number of total funds or number of total units, result in figure we call it as net asset value. Say for example, if I am going to make investment, in the previous example itself I told you one particular example. We have a scheme called ICICI Prudential Asset Management Company has launched a scheme, banking, financial services and insurance. In that the scheme, there are 32 companies have been identified by ICICI Prudential Asset Management Company for making investment. So the unit value, what we call it as a 10 rupees. So they are going to make investment of if you are going to make investment of 10 rupees, the 10 rupees is going to be invested in 32 companies. It means around the 35 paise of your money is going to be invested in each company. So say for example, in that the scheme, around there are about the 10,000 units, it is comes together around the 1 lakh value is considered as a fund what the company is going to make investment. So the 1 lakh is a corpus. So how many number of units that we have? We have the units, 10,000 units we have. So the 10,000 units, the total value of investment is 1 lakh. After a certain period, you take example, now you have invested 1 lakh rupee and you have issued 10,000 units. It means per unit value is 10 rupee. It's the face value of the unit. So after a certain period, if those 32 companies investment is growing or it is declining or advancing and declining partially, what may happen to the market with an average of the 20% increase in the share value in the market. So the 1 lakh, it becomes 1 lakh 20,000 rupees. Hence, what would be the NAV? 1,20,000 divided by 10,000. What is 1,20,000? 1,20,000 is a market value of investment divided by number of outstanding units. Here, how many units issued by the company? 10,000 units issued by the company. Hence, your value, your net asset value is increased from 10 rupees to 12 rupees. So, the 12 rupee, what we call it as net asset value. So that is what it is here mentioned as market value of all the shares in the fund and divided by the number of mutual fund units, which means the total value, market value of investments. Your investment has increased from 1 lakh to 1,20,000. So the 1,20,000 is the market value of investment divided by number of units. How many units issued by the company? 10,000 units issued by the company. So the 10,000. So per unit value is 12 rupees. So what is the unit value, market value of unit, which we call it as a NAV, net asset value. So the net asset value is simply the price per share of the fund. Just like a share, how a share price, likewise a mutual fund have a net asset value similar to the share. Responding to the fluctuations of NAVs as if they were driven by the supply and demand is irrational and will lead to dysfunctionally investors behavior. Rather than it is purely a kind of the investment behavior of the investor that might decides the price movement of the securities in the market. Based on the security value, that decides the net asset value of the unit. NAV is determined solely by the value of underlying securities. What are the underlying securities? Where the fund has been invested, so that the investment, we call it as underlying security. So short term mispricing of underlying securities, if it is been oversubscribed or undersubscribed or overpriced or underpriced or overvaluated or undervaluated, the same effect may happen for the mutual funds also for short term period of time. So the NAV fluctuates on the three important parameters. First one, rise or drop in the value of stock investment. So there is an increase in decrease of investments. Say for example, if I have invested, if I am a mutual fund company, if I am an asset management company, I have invested into the 10 companies. So the value, the total value of 10 companies has increased in certain level. Say for example in 15%. So if I have invested 1,000 rupees, I might get 1,150 rupees. Likewise, whatever it may be your investment you have invested, that aligned with the unit value, that aligned with the net asset value. Changes in the number of shares in mutual fund, it means number of units, how much you have invested, that depends on that. The payout of dividend, capital gain of mutual fund, which also influence the net asset value, which means if you have paid out or pain, it means you have retained the portion of dividend, that might have an impact in the price movement of stocks in the market. The calculation of NAV, how the NAV is calculated, the calculating total value of mutual fund assets subtracted by the liabilities associated with that whole divided by the remaining figure by the number of shares outstanding, which simply we are going to denote the NAV, net asset value, is the total market worth of all securities owned by the fund, specific to the fund, not to the total asset management company, not the kind of the investment, total investment. It is the kind of investment specific to the particular fund, plus liquid cash, the available portion of cash. Whatever whenever we are going for investment, we kept a portion of fund to meet out its obligations. So normally we have some liquid funds, or the funds are to be invested in the money market, so that also we just have included here, and corresponding holdings minus fund liability, the outstanding liabilities associated with this scheme, plus total outstanding shares, it means divided by the total number of outstanding shares. or outstanding units will get the asset value. Importance of net asset value. What are the major importance why we need to have net asset value? Net asset value is simply a price of one mutual funds unit is indicative of funds intrinsic value, real value indicator. There are qualified professionals aiding the investors in their financial planning, so the NAV is most important. The ratio of assets to liabilities can be approached, which helps to determine the level of risk associated with the investment, level of risk associated with the stock, which can be easy to identify based on the net asset value. Net asset value can be valued should the specification of various new forms of investment with its numerous deviations such as absolute return, simple annualized return, compounded annual growth rate. There are a parameter which can be addressed if we have net asset value. We can't be able to compute for all the investment what held by the company what would be its proportion, but it is an indication. We can easy to evaluate, easy to measure the performance of the fund. Thank you.